this computer. Great. So ladies and gentlemen, today we are looking at replacement decisions. And we're going to make our replacement decision using basically our famous tool called net present value. So replacement decisions using net present value. Quite common in your exams in CPA section 5. One of those areas that has always given my students issues, and yet it is easier. So to enable us understand this, we have this section 3 CPA question. Section 3 CPA question, which is November 2017. November 2017. For those of you who are joining us from CPA section 3, you will simply need to go to your revision kit. This revision kit here, you go to page number 102. Go to page number 102. RCM's revision kit, go to page number 102. So page number 102, we are told 𝗕𝗃 Bottling Company is considering replacing one of the bottling machines with a more efficient one. The old machine has a current net book value of 2.4 million with a remaining useful life of 5 years. The old machine has an estimated resale value of 200,000 at the end of its useful life. The existing machine current disposal value is estimated to be 60,000. The new machine has a purchase price of 4.7 million and an estimated useful life of 5 years. The machine is expected to have an estimated market value of 𝗕𝗃𝗃𝗃𝗃𝗃 at the end of the 5 years. The machine is expected to economize on electric power, usage and repair cost, which will save the company 𝗕𝗃𝗃𝗃𝗃𝗃 each year. In addition, the new machine is expected to reduce the number of defective bottles, which will save an additional amount of 𝗕120,000 annually. The company's corporate tax is 30% with a required rate of return of 12%. So the company provides for depreciation on a straight line basis. So they want us to give them the initial outlay. The total terminal, or rather the incremental net operating cash flows from years 1 through years 5. We have the total terminal cash flow, and then using net present value criteria, advise the management of current bottling company whether or not to purchase the new machine. Quite interesting, ladies and gentlemen. I would want to give you 1 minute. You screenshot. You take a photo of that question. 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 Is there somebody who has been able to take a shot of that particular question? Is there somebody who has been able to at least do that little exercise? Because I would want to do the question very fast. Ladies and gentlemen, if it is a replacement question, the basic steps negani. Once in this case, ladies and gentlemen, somebody tells you to sell your old machine, most certainly you are going to make a loss. And the very first thing we will do, ladies and gentlemen, is to calculate the loss on disposal. Come here and give us the loss on disposal. I'm telling you, you buy a machine today, a 10-year-old machine, and then at the middle, year number 5, you start selling it, chances are you'll make a loss. Straight away, you'll make a loss, yes. So what is the loss on disposal? What is the loss on disposal? I know you took a photo of this, right? The loss on disposal, the loss on disposal, the loss on disposal. So ladies and gentlemen, the loss on disposal is here. The loss on disposal is here. We know that this old machine has a current net book value of 2.4 million with a remaining useful life of how many years? 5 years. The old machine has an estimated resale value of 200,000 at the end of its useful life. Now, most importantly, they are telling us that should we want to sell this existing machine today, the existing machine's current disposal value is estimated to be 1060,000. Is estimated to be 1060,000. So ladies and gentlemen, listen. Remember, in financial accounting, for you to be able to get that loss on disposal, you would have done a disposals account. This is how you do it in CPA. Financial accounting. Disposals account, you start by debiting this account here with the net book value of this particular what here, net book value of this particular machine. Remember, disposal of the old machine. So disposal of the old machine, then what do we have? Disposal of the old machine, ladies and gentlemen, they have told us here the old machine has a current net book value of 2.4 million. So this is what I bring first here. So I'd want to put my figures in thousands. So 2,400 like that. And then the other thing, of course, next in disposal, I expect to receive money. So when I receive money out of selling this old equipment, what is going to happen is that I will debit my bank account, I credit my disposals account. So look, in this case here for the proceeds we expect, ladies and gentlemen, to get by disposing this old machine. Who is able to see that figure? 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 Ladies and gentlemen, what figure should I take here as my cash proceeds? As my proceeds of the old machine. Old machine, if I sell this machine today, how much am I going to realize? How much should I capture in my bank account? And then I credit with the same amount the disposals account. The disposals account. So is there somebody who is able, ladies and gentlemen, to see that figure? Is there somebody who is able to see that figure? Here, normally so many people confuse with what? Normally so many people confuse this with the scrap value. Scrap value is at the end of the useful life. Here we are not going to the end of the useful life of this old asset. No, we want to sell it today. And for us to sell it today, we've been told if we sell it today, we are going to realize how much. If we sell today, what are they telling us? That if we sell today, ladies and gentlemen, if we sell today, they are telling us the existing machine's current disposal value is 1060. So in this case here, 1060, I debit the bank, I credit here. So we have here bank. So the bank here is 1060. And of course, now the balancing figure will either be a loss on disposal or profit on disposal. Because, ladies and gentlemen, the balancing figure is coming on the credit side, automatically it becomes a loss. Automatically it becomes a loss on disposal. That is why I'm crediting this account and then I debit my profit and loss. So I'll come and debit or credit this account here with P&L as a loss on disposal over how much here. Can somebody help us here? 2,400 is the bigger value. 2,400 is the bigger value. So what is 2,400 minus 1060? Somebody tell us the figure here. 1340. 1340. You can see the mistake that Nelly has already done up there. Nelly takes the proceeds. Disposal proceeds are not the same as scrap value. Disposal proceeds, the examiner will always tell you the disposal proceeds. Those are two different things. Those are two different things. So ladies and gentlemen, you can see the existing machine's current disposal value is 1060. The 200,000 is a resale value should we consider going to the end of the useful life. So ladies and gentlemen, this is quite important for me. So in this case here, we have a loss of what here? 1340. That is very important. Step number, or rather, of course, I don't expect you to do this in financial management. In financial management, if you do it this way, I'll not be very happy with you. In financial management, ladies and gentlemen, what we normally do is to compare two things. We compare the disposal proceeds of 1060, and then now we look at the current value of the asset. The current value of the asset as measured by the net book value. So the net book value here, you guys gave me a figure of 2,400. You can see, ladies and gentlemen, that an asset that is worth 2,400, we are selling it for a paltry amount, a smaller amount of 1060. So when I subtract like this, what am I going to get? When I subtract, here we are. So you can see that we are making a negative profit. A negative profit is basically a what here? A loss. So a loss of what here? 1340. A loss of 1340. That's how I expect you to do it. Now from there, ladies and gentlemen, step number 2. Now come and give us step 2. This is step 1. This is the first step. So step number 2, come and give us the initial outlay. The initial outlay, amount needed, the amount needed to do the replacement, to replace the old asset, the amount needed today in order for us to replace the old asset, This is easy, very easy, because I look at the cost of the new machine. So we have here cost of new machine. So the cost of the new machine, ladies and gentlemen, what do we have here? The cost of the new machine, what do we have here, somebody? Cost of the new machine, the cost of the new machine. So cost of the new machine, ladies and gentlemen, cost of the new machine, here we are. Cost of the new machine, you can see the new machine has a purchase price of 4,700. So in this case here, cost of the new machine is 4,700. Ladies and gentlemen, remember that, remember straight away, as I procure this new machine, I'm going to get a relief. A relief of what? A relief of, I'm going to get some amount out of selling the old asset. So in this case here, give us the disposal proceeds of the old machine. This will make my life a little bit easier. Disposal proceeds of the old machine, how much? Disposal proceeds of the old machine, 1060. This is 1060, like that. Of course, they have to go in the opposite directions. The moment you take the cost to be positive, then the disposal proceeds revenue has to be negative then. The other thing, ladies and gentlemen, the taxman. So we have here tax on loss, disposal loss, loss on disposal. Remember, we made a loss. On disposal. Whenever you make a loss on disposal, straight away, the taxman will give you a benefit. So this is a tax benefit. A tax benefit is an inflow. The loss on disposal, the taxman will allow you to claim that amount almost immediately. So, ladies and gentlemen, then we need to know what is the rate of taxation given by the examiner. The rate of taxation given by the examiner, somebody is telling me it is 30%. So 30% of the loss on disposal. You are the guys who gave me 1340. Loss on disposal, you gave me a figure of 1340. You gave me a figure of 1340. Which gives me what here, somebody? Which gives me 402. So because we are comparing these two payments and this is a benefit, then straight away, ladies and gentlemen, I'll be required to do what here? To subtract. Because we took the outflow to be positive. So the inflows must be negative. So in this case here, then, ladies and gentlemen, could you come here and tell me what the net initial outlay will be? A good question there. What if we make a profit on disposal? If we make a profit on disposal, of course, then we'll be expected also to do what here? To pay tax on that. Although for the many years that I've ever taught, I've never seen a replacement question, this asset, old asset, ladies and gentlemen, being sold. I've never seen a situation where we make profit. It will be very hard. I've never seen. All of them, we are making what here? A loss. So could you kindly, but should we make in this case here a profit on disposal? That becomes what here? An expense on us. So we will be able to do the opposite of this, which is adding. We add, yes. So 𝗕𝗲 gives me a figure of 3238. So 3238. So this is a very important figure. Remember, at the end of the day, this examiner would need us to calculate net present value. So it's a figure that I expect you to have it at the back of your mind. We'll want to use this figure next. So Roman 2 of this question. Roman 2 of this question is quite an easy one. They want us to give them the incremental net operating cash flows. So they want us to give them the operating cash flows. So how do we get operating cash flows? I can grab this. So operating cash flows, as we operate these machines, the first thing that I'm able to see here, ladies and gentlemen, is depreciation. I can see a student who is saying, he's lost. It's quite unfortunate because, I've got very limited time. So what I don't know is whether once I send the video to you, you'll be able to follow. Perhaps the best is to send the video to you. Because if I start afresh, I'll not finish by exactly 2. Or what is the feeling of most of the students? What is the feeling? Should I start again afresh? I sent the video, yes. Send the video, yes. Thank you very much. Now, in this case here, during operations, ladies and gentlemen, I know the machines are depreciating. That is the first thing. For operational cash flows, calculate depreciation of the new machine and the depreciation of the old machine. That is the first thing you do. So in this case here, please help me to calculate depreciation of the new machine. So we are told here, the new machine has a purchase price of 4,700 and an estimated useful life of 5 years. The machine is expected to have an estimated market value of 600,000 at the end of 5 years. Remember, for us, not unless we are told otherwise, depreciation is straight line. You take the initial cost of the machine minus the scrap all over a number of years. So initial cost here is 4,700. They have given us the scrap of 600. Divide by what here? Somebody number of years, which are 5. Which somebody tells me they are getting a figure of what here? 820. They're getting a figure of 820. That is the depreciation of the new machine. How about depreciation of the old machine? Depreciation of the old machine. Do the same. Depreciation of the old machine. Look for the initial cost. Look for its scrap value. You divide by number of years. So, ladies and gentlemen, what do we have here? So we have the old machine. The old machine has a net book value of 2.4 million with a remaining useful life of 5 years. The old machine has an estimated resale value of 200,000 at the end of its useful life. Let me see what students have done to get. Ladies and gentlemen, then this old machine, I can see its net book value, which now will act like its cost because they have given us what we call remaining useful life. So in this case here, the net book value is 2,400 minus its scrap of 200 over the remaining useful life of 5 years, of which I'm able to see students giving me some great figure. Which figure are they giving me? 440, yes, 440 like that. So please subtract there for you to be able to give us what we call an incremental. Any question, ladies and gentlemen? A question of replacement. For operations and terminal values, we always talk of what here? Incremental. So incremental depreciation. Please subtract this minus this. Please give me an answer. Imelda tells me it is 380. Hilda or 𝗕𝗲 380. By the way, By the way, do we have any student here of CPA Section 3 who has joined us for this class today? Do we have anybody who is from Section 3 CPA? Anybody from CPA Section 3 who has joined us here today? CPA Section 3 who has joined us here today? Ah, great. Only one? Only one? Ah, Miriam as well. Great, 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 great. Thank you very much. Thank you very much. So we have the incremental what here? Depreciation. Incremental depreciation is 380. Now I can rub this. So ladies and gentlemen, during operations as these machines are, as you're grinding them, as you're making them work, we expect to see some fruits. We expect to see incremental profits. So could you kindly come and give me the incremental profits? Come here and give me the incremental profit arising out of our operations. What have they told us? The machine is expected to economize on electric power usage and the repair cost, which will save the company 920. I'm cutting the 3 zeros. So power savings. So in this case here, we are looking at the benefit now of having this machine, the new machine. So we have here power savings, the power savings of 900, it's power and repair savings of 920 of 920. So ladies and gentlemen, after that, what else? They're telling us the machine is expected to have an estimate, apart from that, in addition, the new machine is expected to reduce the number of defective bottles, which will save an additional amount of 120,000. So 120. So ladies and gentlemen, we have here defective bottle savings, defective bottle savings over how much here? They're giving us a total of 120. So could you kindly give me this total? Kindly give me this total. Kindly give me this total. Kindly give me that total. What are we able to get there? 1040. So this 1040 basically is what I will call my incremental profit before depreciation and tax. Is what I'll call my incremental profit before depreciation and tax. I'm interested in cash flow. So I need to come and follow those basic steps. So come here and the less depreciation. Remember, it has got to be the incremental. Do you still remember that particular figure of our incremental depreciation? Do they still remember that figure? Incremental depreciation, do they remember that figure? 380, they're telling me. 380. So please come and subtract this for you to be able to give me what we call profit before tax. For you to give me profit before taxation. So profit before tax, this minus this, please give me a figure. Profit before taxation. So they are giving me a figure of 660. Once I get this figure, ladies and gentlemen, straight away, I'm supposed to share this with the taxman. Share this with the taxman. So come here and let's tax. Remember, they gave us a figure of 30%. They gave us a figure of 30%. So the taxman will get how much here, somebody? The taxman will get how much here, somebody? 198. So once I get this, then I should be able to get what we call the part or the it. I should be able to get the part or the it. The profit after taxation. Profit after taxation. I can see Mwende there, Hilda there, Nelly. I can see Lokai again. Also Njeri. Njeri, I think Njeri is a new student. I've never seen this name here. But very active. Very active. Very active. Profit after taxation is 462. But because I want cash flows, I'll come and add back what here? I'll come and add back depreciation. I'll come and add back depreciation, my incremental depreciation over how much, ladies and gentlemen? Of 380, like that. So could you kindly please give me the total? Give me the total cash flow. The total cash flow, which is operational in nature. Wanasema ni ngapi? Somebody 842. 842 per annum. So the moment I get that, really, I have taken care of the cash flows, operational cash flows for the 5 years, because they are annuities, regular, like that. They are regular. So, ladies and gentlemen, remember, number one, we have the birth. At birth, I need the initial outlay. At birth, kama ni mama ukienda maternity, kuna initial outlay. Squeezing is very expensive. Initial outlay, what will be required? Ladies and gentlemen, from there, of course, we expect benefits as we go along. And again, at the end of the day, remember, there will be what we... Okay, so in this case here, JB what advisor had to get out of the meeting, and then she comes back. Somebody please type for her there. So at the end of the day, there is death. So in death, depending on the kind of parent you are, ladies and gentlemen, we expect to get, if you are a good parent, as you die, we expect to get what we call terminal benefits. Terminal benefit. MK, you will really need a whole discussion of what here, a whole discussion of this NPV. Yeah, because you don't mix terminal cash flows with what here, operations. Operations are regular. So come here, ladies and gentlemen, and now look at terminal. Actually, there are different things. Terminal cash flows. So terminal cash flows, what do I have? Under terminal cash flows, ladies and gentlemen, you'll even see them giving you this as a separate question. You can see here they're telling you to give them the total terminal cash flows. You give them the total terminal cash flows. So has the examiner given us the terminal cash flow? So terminal cash flows will come and pick the terminal cash flow of the new machine. So terminal cash flow, new machine, and then we have terminal cash flow, old machine. So terminal cash flow, new machine, as the examiner given as the terminal cash flow of the new machine. As the examiner given as the terminal scrap value of the new machine. You can see the scrap, ladies and gentlemen, is 600. I hope you're able to see the machine. This new machine, the terminal cash flow is 600. Terminal is 600. Thank you very much. How about the terminal cash flow of the old machine, which we'll have to forego? We'll have to forego this. So it is 200. So in this case here, in short, ladies and gentlemen, our incremental terminal cash flow will be 400, like that. Remember that this is a one-off figure. It's a lump sum figure. So the last question, they want us to give them net present value. Net present value. What do you think shall we do for us to be able to get the net present value? Very easy. I'll take the annuity amount, which is the operational cash flows, multiplied by PVFA, because these will need what you're discounting. Yes, this will need discounting. So you multiply this with the PVFA. At what cost of capital? Are you able to see a cost of capital? There? What is the cost of capital? Cost of capital, at times they will call it required rate of return. Cost of capital. So the cost of, you can see required rate of return is 12%. Required rate of return there is 12%. So at 12%, thank you very much. 12%. For how many years are we going to enjoy this annuity amount? For how many years are we going to enjoy the annuity amount? It has to be the number of years of the new machine. So 5 years. Thank you very much. 5 years. Plus, there is this other cash flow when things come to an end. There is a terminal cash flow of 400, but because it's a one-off amount, we can only multiply it with what we call PVF. PVF is present value, interest factor. It's a one-off amount, yes. It's a one-off amount. So you can only multiply this with PVF, still the parameters are the same. 12% 5 years, and then at the end of the day, we'll come and subtract what year? We'll come and subtract the initial outlay. Who is able to remind us what the initial outlay was? Who is able to remind us what the initial outlay was? Who is able to remind us what the initial outlay? It was 32.38. It was 32.38. Remember that initial outlay is never discounted at all. The initial outlay, if I could rewrite this. First of all, before I write this, I know you great students of mine have got tables. I want you to go to an annuity table. You read for me the PV for 12% 5 years. 12% 5 years. I'm running against time. PV for the annuity table. Annuity, don't use the formula. Annuity table, they're telling me it is 3.6048. How about PVF? PVF for the lump sums. For the lump sums table, 12% 5 years, it is 0.58, 5674, 5674 like that. Now, there is one thing that you guys never told me. There is one thing that you guys never told me. There is one thing that you guys never told me. You never reminded me this annuity amount. The annuity amount, annuity amount, annuity amount, annuity amount. What do we have? Thank you very much, MK. 842. So then the NPV here will be 842 times 3.6048 plus 400 times 0.5674 minus 3238. So who is able to give us that net present value? Who is able to give us that net present value? Who is able to give us that net present value? Net present value, net present value. I can see from Olivia, who is able to give us that net present value, 24.20. 24.20. However small, so long as it is positive, then the decision to replace is viable. So we're advising these people to go ahead and replace, because replacement, I can see it has got a positive value. It has got a positive net present value. A positive net present value. Any question? Any question? Any question, my greatest students? Any question? Any question? Any question? Now, from the look of things, question number two comes from this revision kit. This revision kit, page number 100. Page number 100. This revision kit, page number 100. And remember, today I'm using section 3 questions. Section 3 questions. So this is a revision kit for CPA section 3. CPA section 3. Thank you. So here we are. They are telling us, ladies and gentlemen, they are telling us here, 𝗕𝗕𝗃𝗃 Limited is contemplating the acquisition of a new machine to replace the one currently being used in production process. The existing machine was acquired 2 years ago at a cost of 8 million. The existing machine was estimated to have a useful life of 5 years with no salvage value. However, a critical analysis of the machine now shows that the machine is usable for the next 5 years with a salvage value of shillings 1.5 million. The existing machine can be disposed of now at shillings 4 million. The new machine is expected to cost 12.56 million with a salvage value of shillings 4 million at the end of its useful life of 5 years. The new machine will also be required. So we are told, ladies and gentlemen, here I'm continuing with this, that the new machine is expected to cost 12.56 million with a salvage value of 4 million at the end of its useful life of 5 years. The new machine will also require an additional investment in working capital. And that is why I chose this question that has got working capital. working capital of 2.6 million at the start of its useful life, which will, however, be recovered at the end of its useful life. The following information relates to the estimated earnings before depreciation and the tax over the coming 5-year period for the two machines. We are told here 𝗕𝗕𝗃𝗃𝗵𝐿imited Limited's cost of capital is 13%. The company applies straight line method of depreciation. The corporate tax rate is 30%. So using the net present value technique, advised the management of 𝗕𝗕𝗃𝗃𝗵𝐿imited Limited on whether to replace the existing machine with a new machine. So ladies and gentlemen, I would want us to go slowly with this. I would want you first of all to give me the initial cost of the machine, the initial outlay of this, or of replacing the old machine. I would want everybody to compute the initial outlay of replacing the old machine. I'm giving you 3 minutes. You know, for me to be able to get the initial outlay very well, never forget to calculate this loss on disposal. The loss on disposal is very important. The loss on disposal is very important. So how do I get this loss on disposal? Number one, I would want to get the disposal proceeds. Disposal proceeds of the old machine. So the disposal proceeds of the old machine, ladies and gentlemen, now here, what have they told us? What have they told us? However, okay, disposal machine, the new machine is expected to cost like that with a salvage value of 4 million at the end of the 5 years. The new machine will also require an additional investment in working capital of 2.6 million at the start of its useful life. I'm looking for the disposal. The existing machine was estimated to have a useful life of 5 years with no salvage value. However, a critical analysis of the machine now shows that the machine is usable for the next 5 years with a salvage value of 1.5 million. The existing machine can be disposed of today for 4 million. So 4 million. Let me put my figures in thousands like that. Now I'll come and compare this with the net book value of this machine. Remember, this is at end of year 2. At end of year 2. So at end of year 2, what do we have? At the end of year 2, what do we have? Have they given us this net book value? No. They have taken the approach of 𝗕𝗕𝗃𝗃𝗵𝐿, where they gave us the purchase cost, which is 8,000 of this old machine. 8,000. So to get net book value, I'll take 8,000 minus depreciation for 2 years. Minus depreciation for 2 years. Depreciation for 2 years. For 2 years. For 2 years. So then this will be 8,000. Depreciation per annum will be 8,000. The scrap value they have given us there is 0. And remember, ladies and gentlemen, that the useful life of this old asset was 5 years. We can read again this. We are told, ladies and gentlemen, that the existing machine was acquired 2 years ago at a cost of 8 million. The existing machine was estimated to have a useful life of how many years? 5 years ago, 5 years with no salvage value. But now remember that this will be depreciation per annum. I want it to be accumulated, so times 2. So is there anybody who is able to give me, ladies and gentlemen, the net book value of this particular old asset at the end of year 2? At the end of year 2, Olivia tells me it is 3,200. 3,200. 3,200. 3,200. So this 3,200, ladies and gentlemen, I can see in this case here, this time around, they've made a profit, right? It is not. No, they're saying no. They're saying no. They're saying no. They're saying it's 4,800. So I was wondering, because it's rare for me to get really a question. I've never gotten a question where they're making what here? A profit. So please check again. Or 3.2 is accumulated depreciation. So 8,000 8,000 minus 3,200, that gives us what here? 4,800. 4,800. So then, ladies and gentlemen, in this case here, what do we have? We have a loss on disposal. A loss on disposal of how much here? Of 800. We have a loss on disposal of 800. Can it be 2 plus 5, 7 years? Let's see. The existing machine was acquired 2 years ago at a cost of 8 million. The existing machine was estimated to have a useful life. You see that English was, that time was estimated. They're not saying that from today we are estimating another 5 years. No. The old machine at the time of our acquisition was estimated to have how many years? 5 years. To have 5 years. At the time of acquisition was estimated. Right? 5 years. 5 years. So in this case here, I'm correct here. It should be 5 years, not 7. Not 7. Not 7. Okay. So in this case here, what do we have? 800, which is a loss on what here? On disposal. A loss on disposal. Great. So after I get that, now I'll be able to give you the initial what here? Outlay. Very easily. Once I get the loss on disposal, I'll be able to give you the initial outlay very easily. So initial outlay, what do I have? Cost of new machine. So are you able to see the cost of the new machine somewhere? Cost of the new machine in paragraph number 2, they're telling it's 12,560. I'm putting my figures in thousands. In paragraph number 2, what I would request is that you take a snapshot of this question kindly so that I get free from this thing of sharing my screen. Okay, so ladies and gentlemen, now here we are. We've been able to get cost of the new machine. It is 12,500 what here? 60. Now from there we've seen the concept of what? We've seen the concept of working capital. This machine is not coming to run itself. There is working capital. So in this case here, add working capital. Working capital of how much? Of 2,600. Working capital. There is a working capital, additional working capital of 2,600. Thank you. Working capital of 2,600. Now, ladies and gentlemen, remember initially, should we decide to replace today this thing, we are going to get a relief. We're going to make some, or rather to get some money out of selling our old equipment. So in this case here, come and give us disposal proceeds. Old equipment. Is there anybody who is able to see this disposal proceeds of the old equipment? Old equipment disposal proceeds in ngapi? 4,000. Okay, let me stop recording a little bit. We discussed this issue of accumulated depreciation. So allow me kindly to repeat this concept of what here? Net book value. Specifically, I would want us to get the depreciation of the old machine. So depreciation of the old machine, what have they told us? In line number 2 of the first paragraph, they're telling us here the existing machine was acquired 2 years ago at a cost of 8 million. The existing machine was estimated to have a useful life of 5 years with no salvage value. Leave alone this other paragraph which could really confuse you. This other paragraph will be coming in later. We'll be computing depreciation for purpose of comparing later. This one which says, however, a critical analysis of the machine now shows that the machine is usable for the next 5 years with a salvage value of 1.5. The existing machine can be, so leave this one. This one, ladies and gentlemen, of course, entails what? Change of accounting policy. When we are, of course, continuing with our operations. So when we change our accounting policy, like now this one, later on we'll be required to calculate now what year a new depreciation amount for purpose of comparison. But initially, this is where we are. Remember, we are making this estimation initially. This is where we are. So 8,000 minus 0 divided by 5. This will give me what figure? They're telling me it's 1,600. 1,600. So how do we get net book value? To get net book value, we normally take the initial cost minus, in this case here, accumulated depreciation. So then the initial purchase cost here is 8,000. Accumulated will be 1,600. For how many years have we been with this machine? Times 2. Times 2. So then that will give us what figure at the end of the day? That will give us what figure at the end of the day? So net book value will be 4,800. But now remember that this person wants to buy this machine. The person wants to buy this machine, at what disposal proceeds? Something lower than what our value is worth, than what our machine is worth value-wise. So I can see a loss there. So are we together, first of all, up to there? Are we together? Or what argument do you have? Okay, great. So then, gentlemen, we have here disposal proceeds of the old equipment, 4,000, because you're putting it in a cost statement, initial outlay statement. Then this one here should be put in bracket like that. Right. After that, ladies and gentlemen, of course, I expect you to come and capture something that most of us will forget. The tax benefit. The tax benefit arising out of what year? Arising out of our loss on disposal. Arising out of our loss on disposal. Remember, you were the ones who told me that our loss on disposal is 800. Our loss on disposal is 800. So 800 times what year? Times 30%. So 800 times 30%, that gives us what year? 240. Because it's an benefit, it has to be taken as a what year? As a negative, because we are putting these figures in a cost statement. So then at the end of the day, what figures are we looking at as our initial outlay? What figure are we looking at? Somebody. They're giving me a figure of 10,920. 10,920. And there is a student who got this figure correct. Kusema ukweli, kama ingekuwa ni mwezi iko katikati ya kona, leo ningekuzawadia hata 2,000. Ni mwezi tu iko mahali mbaya. Yeah. 10,920. 10,920. Very good. So that is the answer, 10,920, and I believe now I can rub my board like that. So thank you very much. So, ladies and gentlemen, now that takes me to something very interesting. What else will I come and look for? Yes. Now I go to the next step, which is the step of what year? Operational cash flows. Go to the next step, which is the step of operational what year? Cash flows. Go to the next step, which is the step of operational. Cash flows. During operations, what do we expect? That one I would want to give you 3 minutes. Ujaribu kabisa peke yako. So we look for incremental depreciation. This is the name of the working. So incremental depreciation, what do we have? Number one, we have depreciation of the new machine. Depreciation of the new machine. So depreciation of the new machine, ladies and gentlemen, at the end of the day, we know the cost of the new machine, don't we? We know the cost of the new machine. We know the cost of the new machine. We know the cost of the new machine. The cost of the new machine was 12. Let me just share this very fast. The cost of the new machine, ladies and gentlemen, here is 12,560. It's 12,560. So 12,560 minus its scrap value. Scrap value is 4,000, 4,000,000 for our case because we are cutting 3 zeros. So 4,000 divided by number of years ambazo ni ngapi? Number of years. What do we have as our number of years? Number of years. Are you able to hear me now? Are you able to hear me? Number of years, 5 years. 5 years. So then could you kindly give me this depreciation here? Give me this depreciation here. 1712. Thank you very much. 1712. Thank you very much. From there, come and give us the depreciation of the old machine. Depreciation of the old machine. Depreciation of the old machine. So for the old machine, I should take what minus what divided by what? For the old machine, I should take what minus what divided by what? Eight minus 0 over 5, Winnie. Thank you very much for trying, but that is wrong. That is wrong. That is wrong. So Ruth says it should be 4,800 minus 1,500 divided by 5. This is what is correct. And I will explain. Ladies and gentlemen, remember we bought this machine some 2 years ago. We bought the machine some 2 years ago, and we bought it for 8,000, right? And I did an estimation where we said that for these 5 years, this thing's scrap value will be what year? 0. Now we have come at the time of what year? At the time of replacement, 2 years later. At the time of replacement, ladies and gentlemen, listen, because the number of years here left are how many? 3 years, which are not identical to the number of years of the new machine. Because the number of years, the running period for the two machines, remaining period for the two machines must be identical. So because in this case here, the new machine, the old machine's period is not, it's 3 years instead of 5 years, we have to get away of elongating it. We have to revalue it. So in terms of revaluing it, ladies and gentlemen, this is what we came up with. Number one, in terms of revaluing this, we got to find an estimated 5 more years. So these 5 more years, what do we have? They have given us the scrap value. Scrap value for the old machine after elongating the period. What are they giving us? After elongating the period, the scrap value after elongating the period, they are telling us, however, a critical analysis of the machine now shows that the machine is usable for the next 5 years with a salvage value of 1,500. A salvage value of 1,500. So the salvage value here, which is scrap value, is 1,500. But now the question now comes here. What figure should we put here? Ladies and gentlemen, here now we should work with NBV, net book value, as our purchase. And that is why in section 1, you are told that whenever there is a revaluation or a change of useful life, for you to get depreciation, then take net book value as at the time of revaluation minus the scrap all over n. This is what we are told in section 1. So net book value as at the time of changing the period is 4,800 minus the scrap, which is 1,500, all over n, which is what year? 5 years now, 5 years from today, moving forward. Don't tell me the thing of 7. Moving forward, 5. So then, ladies and gentlemen, what figure do we have here? Somebody is giving me a figure of 660. So could you kindly subtract here to give me the incremental depreciation? Please give me the incremental depreciation. Give me the incremental depreciation, 1052. So we have here incremental depreciation, incremental depreciation. So we are learning something very important here. Whenever we have got a change of either value in the middle, or you have changed the duration, then automatically this formula is very important. Net book value, which you had calculated after 2 years, minus the scrap, all over n, like that. And there is somebody, by the way, who got this 1052. There is somebody who got this 1052. There is somebody who got this 1052. Ladies and gentlemen, after that, now I should be able to get my incremental cash flows very fast. Now I should be able to get my incremental cash flows, and I'm giving you exactly 2 minutes for you to do that for us. I'm giving you exactly 2 minutes for you to do that for us. Incremental cash flows. So incremental cash flows, what do we have? We'll come and take here. They have given us the profit before depreciation and tax for the new machine. And then we have the profit before depreciation and tax for the old machine. Right? So please get there and copy these very fast. I hope you are able to see the ones of the old machine. So for the old machine, what do we have here, somebody? So in this case here, we have, oh, it's 54, not 34. Right? Yeah, it's 54. I don't know how I'm getting, supposed to be 54. Thank you. Thank you. Thank you. Thank you very much. Thank you very much. So, ladies and gentlemen, come here and give us the old machine. The old machine, profit before depreciation and tax. The old machine, profit before depreciation and tax. What figures do we have? So I can see them vividly. The first year, we have got 3,200. 3,200. 2,800. The other one is 3,000. We have 2,400. We have 2,000. So please subtract for you to get that incremental PBDT. For you to get the incremental PBDT. Is there somebody who is able to give us that incremental? The incremental. So the incremental PBDT. What figures do we have, somebody here? What figures do we have, somebody here? The first one, 5,400 minus 3,200. Please give me the figures very first. Please give me the figures very fast. Give me the figures very fast. I'm not seeing any figure. I'm not seeing anybody giving me any figure. $13,600. Did you add or something? No. We are subtracting. We want to see the increase. If we bring this machine, how will our profits here increase? So the first one, I'm being told, is 2,200. How about the second one? How about the second one? The second cash flow is 2,600. How about the third one? The third one will be 2,400. 2,400. How about the fourth one? The fourth one, this 54, this will be 3,000. And then we have the last one, which is 3,400. So, ladies and gentlemen, that is our incremental PBDT. So once I get that, I need to come and subtract the incremental depreciation. So less our depreciation. Are you able to remember our depreciation? Are you able to remember the incremental, of course? Are you able to remember our depreciation, the incremental one? The incremental depreciation. What figures are we getting? Somebody there? The incremental depreciation, do we still remember it? 1052. It's a regular one. It is a regular one. It is a regular one. So I'll come and subtract this for me to be able to get my profit before tax. So profit before tax, what parameters do we have here? Profit before tax, what metrics do we have here? Somebody talk to me. What metrics do we have here? What metrics do we have here? Somebody talk to me. The first one, somebody tells me, is 1148. 1148. The first one is 1148. 1148. The second one, ladies and gentlemen, will be 1548. 1548. The third one, the third one, the third one, 1348. The third one is 1348. There is somebody who is saying that the incremental depreciation is 600. Really? Incremental, the one that we got after subtracting, were we getting 600 really, or 1052? So I can see 1948, 1948, and then lastly, it's 1052. Yes, it's 1052. 2348, 2348, 2348. Thank you very much. So having gotten profit before tax, now we have adjusted for depreciation. The next thing itakuwa ni gani, somebody? The next thing itakuwa ni gani? We less tax. Thank you very much. So less taxation, you less taxation, you less taxation. So taxation, we less taxation. They have given us the rate, a rate of 30%. So 30% of 1148 gives me what figure? 30% of 1148. This gives me 344, 344.4. 30% of this, 464.4. 404.4. 584.4. The last one, the last one, the last one, the last one, 704.4. 704.4. So subtract like that. When you subtract like that, now you should be able to give us what we call profit after what year? Profit after taxation. Now you should be able to give us profit after taxation. So this one here I'm told is 803, 803.6. Thank you very much. Go to the second one. Go to the second one. Thank you very much, you guys, for not sleeping. Thank you 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 for not sleeping. So 803.6. The second one. 1083.6. 1083.6. Fourth, 1363.6. 1083 point, no, that I have. 1643.6. 16. Nope. 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 943.6. I think the 16 one is here. The last one, 1643.6. So having gotten this profit after tax, what do you think will be the next thing to be done? We add back depreciation. Add back depreciation. Add back depreciation. So depreciation we are adding back. Remember the figure here is 1052. 1052, 1052, 1052, 1052, 1052. So please, you are adding back for us to be able to get what we call operational cash flow. Operational cash flow. So please, we are adding. 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 1855.6. The last one is 2695.6. Okay. So what figures are we getting, ladies and gentlemen? So year number 1, number 2, I can see 2135, 2135, 21.5, 2135.6. Please write there. Year number 3, write the year. 1995.6, 1995.6. How about year number 4? How about year number 4? How about year number 4? What do we have there? Year number 4. The last one. Year number 4, 2415.6. Thank you very much. So I don't know whether all my figures are correct. Are all my figures correct? Are all my figures correct? Thank you very much. So, ladies and gentlemen, remember this is a tabular. I can see there are many cash flows, many cash flows, all of them for the lifetime. So it will be very important for me to come and add the terminal. Add the terminal. Add the terminal cash flows. Add the terminal cash flow. Ile mwaka ya mwisho kabisa tukiterminate, we need a working here. We need a working there. We need a working for the terminal cash flow. We need a working for the terminal cash flow. So could you kindly go ahead and give me the terminal cash flows yourselves very first? Please give me the terminal cash flows yourselves very first. The terminal cash flow. When we terminate this project, what will happen? When we terminate the project, what will happen? When we terminate the project, Olivia anasema, why can't you use the easy way of EBIT plus? Of course it is easy. I know those things. With the kind of knowledge I have in finance, I know them. But from experience, I know this is the method that very many students will never go wrong, especially when they come and mix other things. This is a method I recommend. I have so many shortcuts of finance. So many shortcuts of finance. I don't think there is any finance. Having done P4 of ACCA, I don't think there is anything in finance really that is something. I'm a man of shortcuts. Very good. But for this one, the longer way. Okay. Great. So now we are looking for the terminal cash flows. Winnie says 2,500. Winnie says 2,500. No. All of you are wrong, but thank you very much for trying. All of you are wrong, but thank you very much for trying. Try more. Keep on trying. 5,100. Let me see. Yes. So remember, in terms of terminal cash flows, ladies and gentlemen, what do we have? Terminal cash flow. We have disposal proceeds, not disposal, but the scrap value of new. So the scrap value of new, they are giving me this figure somewhere. The scrap value of new, they gave me 4,000. And then we have scrap value of old. Scrap value of old, they gave me somewhere a figure of 1,500. Remember, old is an opportunity cost. It's an opportunity cost. I'll lose that. If I make a replacement decision today, I will lose this money. So I'm capturing it in brackets. Then, ladies and gentlemen, when we terminate this, we have working capital being released. So in this case here, come and talk of add, release. Release of what here? Working capital. Release of working capital. Remember, working capital is normally injected at the beginning of the period and it's normally released. So add release of working capital. So you're able to see the release of the working capital was 2,600. And I want to believe that this is how they got their 5,100, which will come at termination. So this is what we put now here, 5,100. Could you kindly add this? Kindly add this figure and this figure. Add. Give me the total. Add this figure and this figure. Add. Remember, this figure is only coming to us only once at the end of the project. At the end of the project, please add here. Add there, add there, add there, add there. Add there, so that they have done very well. Thank you very much. So in this case, ladies and gentlemen, now we have our NPV schedule. So net present value schedule. So our net present value schedule, ladies and gentlemen, what do I have here? Our net present value schedule, what do I have here? I have year number one, actually you can even begin from year 0. Year 1, year 2, year 3, year 4, year 5. So year 0, do we have our initial outlay? Year 0, do we have our initial outlay? Who is able to remember our initial outlay? Who is able to remember our initial outlay? Who is able to remember our 10,920? So the 10,920 now, it's an outlay. It has to be put in brackets like that. Year number 1, I know I will achieve this 18, 55.6. Year number 2, I will get 21, 35.6, 35.6. This one here, we have 19, 95.6. This one here, we have 24, 115.6. And then year number 5, lastly, you guys gave me 77, 95.6, like that. 77, 95.6, 77, 95.6. Now, ladies and gentlemen, after that, what do we do? After that, now come right away here and discount. So we are discounting this at what year? At PVIF, because you can see these ones are irregular. They're irregular. So we're going to use the present value interest factor, the PVIF. So the PVIF, ladies and gentlemen, what do we have here, PVIF? What do we have here for PVIF? For PVIF, ladies and gentlemen, what we have here for PVIF, the cost of capital is 13%. The cost of capital is 13%. So is there anybody who has a table that has got that 13%? The lump sum table with 13%? Could you kindly read these figures for us? I know that at time 0, the PVIF will always be equal to 1. Times 0, the PVIF will always be equal to 1. At time 0, the PVIF will always be equal to 1. Is there anybody who has got 13% in their table? If you don't have them, you know the formula. You know the formula. This is supposed to be 1 plus R. 1 plus R. Supposed to be 1 plus R raised to negative n. So like the first one will be 1 plus 13%. 1 plus 0.13. So inakuwa 1.13 raised to minus 1. So I'm being told that the first one is supposed to be 0.5. No. The second one here is supposed to be 0.8850. 8850. How about 1.13 raised to power 2? 1.13 raised to power 2. Power negative 2. Power negative 2. So power negative 2, I'm being told is 0.7831. And then Lokai gives me the last one. The last one is Lokai, who has given me the last one, 0.5428. 0.5428. And then now we have the next one. The third figure, 0.6931. 0.6931. And then now the fourth figure, is there anybody who has got this fourth figure? The fourth figure is 0.61, 0.6133, like that. 0.6133, like that. Thank you very much. There is a student who is asking how we got this figure. Remember this figure in year number 5. We had our operational cash flow. We came and added our terminal TC, our terminal cash flow. Now, having gotten this, ladies and gentlemen, come and multiply this to be able to give us our discounted cash flows, to be able to give us our present values. So present values, what do we have? 10,920 times 1. So this gives me negative 10,920. Now you go to the second one, this and this. Please give me an answer. 2 decimal places. For present value, 2 decimal places. That is very good. PVIFs and PVIFs, those are the ones in this case here that must go. all the way to how many decimal places? 4. 4 decimal places. So I'm being given a figure of 1642. 1642.21. Thank you. Thank you. Please go to the third figure. The third figure. What do we have in the third figure? What do we have in the third figure? What do we have in the third figure? 1907.32. 1907.32. Go to the fourth figure. The fourth figure. The fourth figure. The fourth figure. Go to the fourth figure. What do we have? Somebody there. Fourth figure. Fourth figure. So the last one is 4231. The last one is 4231.45. Don't mind about the decimal places. So please, I'm looking for the fourth figure. Fourth figure, 1383. 1383.15. How about this? The second I'm told is supposed to be 1672, not 42. This one, okay, 1672. This one I'm being told is supposed to be 1672. This one, I'm being told is supposed to be 1672. So this one, the last one here is 1481. 1481.49. So could you kindly come and add for me? Give me the total net present value. It's net present value because as you're adding, of course, you are netting off the initial outlay. You are netting off the initial outlay. You are netting off the initial outlay. So the total net present value at the end of the day will give me what figure? Somebody here. The total net present value at the end of the day. So again, Olivia tells me that the second one is supposed to be 1642, not 72. Who is correct? Who is correct? Who is wrong? Who is correct? Who is wrong? 1642. So I'm being told that this is supposed to be 1642. Sorry for that. 1642. So which one is 1672? Which one is 1672 for the third one? Third figure is supposed to be 1670. They're telling me that the third figure. Now, the third figure, are we talking of the third year? Are we talking of the third year? Are we talking of the third year or second year? Year 2. Year 2 is supposed to be 1672 point. 1672 point. 1672.39. Thank you very much. So now I suppose that all our figures are correct. I suppose that now all our figures are correct. They are correct. So then could you kindly give us the total net present value? The total net present value, which will end up giving us negative 244, negative 244. Can somebody else confirm this? Can someone else confirm this? Can someone else confirm this? Can someone else confirm this? Negative 244.38. Carol says no, negative 457. Another one says negative 509. I don't know why they're getting different answers. 510 and 509, those are the same. Those are the same. 513, I'll still give you. Quite close. So most students are saying no, this is supposed to be negative 509, negative 509.31, negative 509 point what year? 0.31 negative. And because of NPV being negative, we say straight away, ladies and gentlemen, that this particular what year replacement decision is not viable. It's not viable. It's a bad one. It's a bad one. Reject. That is the word. Reject the replacement decision. So, ladies and gentlemen, it has been a pleasure hosting you this afternoon. I want to believe you have gotten some inverter. I have a student here who is saying that it's supposed to be negative. It's supposed to be negative 244. Please check your answers. Check your figures here. I'm so sure there is a figure that I rubbed here. You never changed yours. There is a figure that I rubbed here and you never changed yours. You never changed yours. Now, a student is